All right, let's dive into a really important shift happening in decentralized finance. We're talking about the move from what everyone calls DeFi 1.0 to DeFi 2.0. And look, this isn't just some minor software update. It's a huge change in thinking, moving away from pure hype and toward building something that can actually stick around. And this slide right here, this gets right to the heart of it. DeFi 1.0 is all about these wild, headline-grabbing numbers. You'd see things like 10,000% APY. But DeFi 2.0, it's focused on something way more important and honestly more practical, creating sustainable returns that can actually survive a bear market.
So that leads to the million-dollar question, right? What actually changed? What was the fundamental problem that forced the entire space to grow up and evolve? Well, that's exactly what we're going to break down.
To really get this, we have to start with the two absolute pillars of DeFi, yield and liquidity. I promise, once you wrap your head around how these two concepts work and how they work together, everything else is going to click into place. First up, let's talk about yield. Super simple definition here. Yield is just the interest you earn in the DeFi world. You know, whether you're staking your tokens, lending them out, or adding them to a trading pool to provide liquidity, that return you get back, that's your yield. Pretty straightforward. But here's the thing. Not all yield is created equal, not even close. You can kind of think of it in three flavors. First, there's incentive-based yield. These are those crazy high but totally temporary rewards designed to get users in the door. That was the signature move of DeFi 1.0. Then things get more stable with fee-based yield, which comes from real activity on the protocol, like trading fees. And finally, you have the rock-solid foundation of DeFi 2.0, yield that comes from actual productive assets, like staked ETH or even real-world assets. That's where real sustainability starts. Okay, so now for our second pillar, and this is where it all connects. You're going to hear this phrase a lot because it is 100% true. In DeFi, liquidity is the absolute lifeblood. Without it, the whole system just grinds to a halt. So why is it the lifeblood? Well, because it's what makes everything work. Liquidity is what lets you swap tokens without sending the price to the moon or crashing it to zero. It's what allows people to borrow large amounts of capital, and it's what gives lenders the confidence to even provide that capital in the first place. It just makes the whole market run smoothly. So if liquidity is so critical, what was DeFi 1.0 getting so wrong? This quote just nails it. The liquidity was rented. It was never owned. Protocols were stuck in this endless, super expensive cycle of basically bribing users with their own tokens just to get them to keep their money in the system. And this whole rented liquidity model, it created what you could call the DeFi 1.0 trap. It was this crazy, vicious cycle of boom and bust. It was exciting for a minute, for sure, but in the long run, it was completely unsustainable. Let's look at the core flaws of that trap. First off, those insane rewards weren't coming from real revenue. The protocols were just printing more and more of their own token, which, you guessed it, led to massive inflation. Second, the liquidity was totally mercenary. It was only there for the rewards. The second those rewards dried up, poof, the liquidity was gone. And that meant there was absolutely no long-term alignment. Users weren't partners, they were just short-term renters. Okay, so if that was the broken model, how do you fix it? Well, this brings us to the genius of DeFi 2.0's sustainable fix, a whole new model designed from the ground up to build protocols that can actually last. This chart right here, this is the aha moment. You can see the problem and the solution side by side. Instead of inflationary rewards, you have real revenue. Instead of rented liquidity, you have permanent owned liquidity. And instead of short-term yield farmers, you get users who are aligned with the protocol for the long haul. It's a complete 180 in philosophy. And the biggest innovation that makes all this possible is something called Protocol-Owned Liquidity, or POL for short. Instead of constantly paying rent for liquidity, protocols just buy it. They own it themselves. This is a total game changer because it turns a protocol from a money printing machine into a sustainable business with a real balance sheet, a stable foundation they can build on top of. But it's not just about owning the liquidity. It's also about managing it way smarter. DeFi 2.0 brings in all these clever systems, like automated management to keep pools balanced and algorithms to protect users from things like impermanent loss. You know, that nasty situation where the value of your tokens in a pool actually goes down compared to if you had just held them. Plus, it uses smart routing to make sure liquidity is always exactly where it's needed most. So all of this creates a totally new playbook for how you generate yield. Now, yield is backed by real revenue from fees and even real-world assets.
We're seeing advanced stuff like restaking, where you use your already staked assets to help secure other networks for extra rewards. And crucially, risk management tools like insurance and hedging are being built right into the protocols themselves. When you put all these pieces together, what you get is a completely new paradigm. We're literally watching the future of real yield take shape, a move away from those fantasy numbers and towards something that can actually be sustained for years to come.
Because of all these innovations, the entire conversation around what makes a DeFi protocol successful has fundamentally shifted. The questions people are asking now are completely different from what they were asking a few years ago.
It really all boils down to this. The whole mindset has gone from asking how high can this yield possibly go to asking a much smarter, much more important question. How long can this yield actually last? That question, right there, is the very soul of DeFi 2.0, and it's the key to understanding where this entire space is headed.
This is DeFi Evolving. Visit Web3 Newswire for more updates on Web3 projects. Link is in the bio.